Brian Dunlap, welcome to the show.
Thanks for having me.
You got it, man. This is, and thank you to everybody for tuning in to this week's show. This is Sharpe Minds Podcast, and I'm your host, Michael Lafata. It's not too often that you get the opportunity to sit down with, one of the largest asset managers in the world, or the largest asset manager in the world, I should say. And to be able to have a long-form discussion, to hear their viewpoints, hear their insights, and hear what they have to say is a fantastic opportunity. So we're joined by Brian Dunlap from BlackRock today. And Brian, you've actually been there for almost 2 decades.
Almost 2 decades.
Yeah, that's...
I know I don't look like I could have worked somewhere for 2 decades, but yeah, it's almost 2 decades now.
Dude, that's amazing, man. So around the time that you've started,
yeah.
So I did a little bit of research into this. In 1999, BlackRock had 165 billion in assets under management.
Yeah.
And today, or at the end of 2024, they were at 11.5 trillion.
That's right.
So you've seen, the bulk of that growth throughout your time there.
Yeah. It's been a pretty fun ride to see the firm grow from what was still a big asset manager at the time, but into one of the most scaled asset managers on the planet, or as you said, the most scaled asset manager on the planet.
Yeah, and so you were one of the relatively early employees.
Yeah.
I would guess. And just tell us a little bit about what that process is like, seeing the firm evolve so much.
Yeah.
If they've done some huge acquisitions that have helped with that growth.
For sure.
And they just have had great management throughout the years. But tell us a little bit, about what that experience has been like, and what some of the most exciting parts have been like for you.
Yeah, so I kind of came from the old Malim world, the Merrill Lynch asset managers, when BlackRock purchased the asset management arm off of Merrill Lynch. And it's funny, we kind of came into the BlackRock world, and not too much changed at first, because I was in our group where we were calling on financial advisors and working with you and your clients, folks like yourself. And sort of the name just changed at the beginning, right? Instead of saying Merrill Lynch, we said BlackRock. But as time evolved and we continued, our founder, Larry Fink, and Rob Capito and others made some really smart acquisitions, whether it was buying BGI, iShares effectively in 2009, which at the time as an active guy, I said, what are an index is an index. What are these ETF things? Yeah. But boy, was I wrong. And now, I live and breathe the index world, the ETF world, I should say. And it's been pretty cool to see these innovations happen over time. And, today when we think about how we engage with, our clients, our financial advisors, as we've made different acquisitions, whether it was, customized SMA shops, options overlays, private markets, infrastructure. Now I think the exciting part has been that I think today BlackRock's more relevant to our clients than any other firm on the planet. We can help advisors, build the house with, the design and the blueprint, and we can also be a really high quality parts provider with like the right investments underneath, and help advisors think through it through the context of a portfolio, like the whole portfolio, not just products. So that's been, I think, the most exciting thing is that whatever we've done, it's been all around relevancy to our clients. Let's
put a pin at that. We'll come back to it.
Sure.
I want to give you a little bit more background, provide an intro.
Sure.
And then we'll come back to the ETF specific piece.
Sure.
So in addition to being there for almost 2 decades, in your current role, you represent views and research and related investment products for BlackRock's thematic, active equity, and digital assets suite.
That's right.
And in addition to that, you've done a handful of things. Most notably, you ran the fixed income and multi-asset business within the U.S. Wealth Advisory business at BlackRock. So that's great, man.
Yeah, I've had, like you said, I've been here a while and done a handful of different things, which has been really got a chance to partner with, folks all around the firm, kind of up the chain and across the chain, which has been really, really nice.
What made you move from the wealth advisory side to sort of the thematic and I guess more of the ETF specific side?
Yeah, sure. So the old business that I was in, kind of running the business, if you will, for fixed income and multi-asset, as that migrated a little bit further away from being in front of folks like you and clients, that's for me really where I drive my energy from. And I was really, really lucky. The opportunity actually kind of found me, an opportunity to get back in front of clients. And the icing on the cake, in addition to doing more of this type of work, was the type of products, the type of market insights we were going to be bringing around this idea of thematics and megaforces, around active ETFs, around digital assets, that was really exciting, really innovative parts of what our firm was doing. So not only was I doing functionally what I really, really like, but I could do it in a part of the market that was evolving and becoming, just expanding the toolkit for clients to help deliver outcomes, advisors deliver outcomes for your clients in more thoughtful and more precise ways. So that was a really nice transition for me to get back to this side of the business again.
Yeah. And I think you hit the nail on the head, at least with one piece of it. But, because from my perspective, the iShares part of the business and that ETF suite is sort of what BlackRock is known for, in my opinion. Yeah. Right? Those ETFs are everywhere.
Yep.
They're known for being on the cheaper side,
yep,
which helps, over the long term. And in addition to that, makes it more accessible for the retail end client.
That's right.
And then the point that you touched on was the innovation. Mm-hmm. You guys have been at the forefront of innovating with inside that ETF wrapper, and coming up with many of these different themes. Mm-hmm. And there's not, it's not often that I think of a type of ETF that I want to look for or that we'd like to incorporate in something, and there's not an iShares version of it. That's
right.
And so in some
for the most part, yeah.
So is that sort of how you guys think about it, right? The iShares brand has become so big because of cost, accessibility, diversity, and then what's that last word that I'm thinking of? Innovation. Innovation. Yeah.
Yes, I think you kind of hit the nail on the head. And to your point, I think for most folks, if they're looking for something, there is an iShare. Not always, because while many times we are the first mover, we like to move right, not fast, and make sure that we're providing something to clients that's not going to break, right? But you mentioned that part of our brand, not just being the biggest asset manager on the planet, but being thoughtful. And if we're venturing into a space, we want to do it because we have confidence and conviction that not only is the space investment worthy, is the vehicle, the wrapper, ETF or what have you, the right kind of path to get there, but also it's going to provide the right outcome to clients. So we're not always the first mover. A lot of times we are, but we like to go right, not fast. But that is how we think about it. And the ETF, has really evolved. And you talked about low cost, for a really long time. That's what the ETF was known for. It was low cost, kind of market cap weighted beta. And it grew. The ETF industry grew dramatically. I think it went from $2 trillion in 2014 to $10 trillion in 2024. So over that decade, you saw $8 trillion or 5x growth in the overall ETF space. You saw more than 2.5 times the number of ETFs. There's more than 4,000 ETFs in the U.S. market today.
That's crazy.
There's almost more ETFs than stocks. Yeah. More ways to slice the stock universe than there are actual stocks. But I think that the growth in the ETF space moving forward will be around the innovation part that you talked about. Yeah. Bringing alpha-seeking managers into the ETF wrapper, bringing outcomes into the ETF wrapper. You can now use derivatives in ETFs in a way that you couldn't before. The ETF vehicle prior to 2019, it couldn't. The technology couldn't take it. Now it can. Thematic exposures, digital assets, now getting cryptocurrency exposure in the form of an exchange-traded product. Creates efficiencies for clients. It unlocks new exposures for clients. And it's helping advisors like you deliver clearer, more precise outcomes for clients, all because the ETF wrapper is innovated in, I think, a really, really remarkable way. And that, in my opinion, will be what continues to propel the ETF growth as we move forward from there.
The versatility of it.
100%.
It's can you speak a little bit to sort of like the technology behind it?
Behind the ETF?
Yeah, what makes it so versatile?
Yeah, so similar to a mutual fund, right? For the most part, they're 40 Act traded technologies, if you will. There was an ETF rule, and we don't need to get into the logistics of kind of legislation, but the ETF rule of 2019 created a lot more flexibility in terms of what regulators would allow to go into the technology. So the technology was able to kind of incorporate some of these things. Regulation didn't always allow it. But also the infrastructure with the market makers and the authorized participants who are helping facilitate the exchanging and the trading, et cetera, of the ETFs have gotten a lot more comfortable with different markets. I think of bank loans, right? Like we didn't have active bank loan ETFs in the past because it was literally they used to deliver bank loans. They would settle by bicycle courier. Yeah.
When did that?
Not all that ago. It still takes, most bank loans still take, while you do T+1 in most stocks, bank loans still take a longer period of time to settle, but because these authorized participants and the market makers have gotten more comfortable, whether it's taking on inventory or just the trading infrastructure, that's allowed for some of these other what I'd call non-traditional or non-historically leveraged vehicles or kind of underlying securities, whether it's loans, which are technically securities, or derivatives to be used in the ETF wrapper and the technology.
Yeah, that's awesome.
And also the demand, when you just think about demand, because ETFs have two levels of liquidity, right, in terms of being able to trade them. It's the actual ETF, how much of the ETF trades, but also the underlying inside of it. So as more demand has come for ETFs, the volume is increased. That's allowed us to have more liquid products, which enables us to just do more.
Yeah, you spoke to the acceptance of these different markets, right, and why that space has been able to grow from a legislative point of view. And then you also touched on Megaforces.
Yeah.
So that's going to be the bulk of our conversation today is these Megaforces, and that's a term that did you guys coin that term?
I think we may have coined it. We used to call them mega trends, and then somewhere along the way, before I got into this part of the business, somebody came and said mega forces.
I like
it's
that.
like more powerful, I guess. But yeah, I think we might have coined the term mega forces in the industry. Yeah.
Yeah, I like it. But let's dive into that a little bit, right? Tell us a little bit about what the term means,
Sure.
and what it really represents, and some of what those Megaforces actually are.
Sure. Yeah. So I love that question because a lot of times it's when people talk about what they do, and I tell people I sell, represent products for Megaforces. Like, what the heck are Megaforces?
Yeah.
But I like to try to keep it simple. What are they? Global shifts that are changing the way we live, changing the way we work, and changing the way we spend money.
Mm-hmm.
That's what Megaforces are. And because of those three things, we have a high degree of conviction that Megaforces, and I'll talk about what those are, will drive outperformance from an investment perspective versus broader markets over their adoption cycle. Typically, for these Megaforces, it's a more structural move. So these adoption cycles could be a decade long.
Mm-hmm.
If you look back, and I'll talk maybe about this more later if the opportunity presents itself, but at the unequivocal Megaforces of yesteryear, smartphones. Everybody has a smartphone today. That wasn't the case in 2007 when Steve Jobs put a phone, a camera, and the internet all in one device. Now we're at 85, 90% penetration or market saturation. But that went from 2007 to call it like 2019 to get to 85% market saturation. That's more than a decade in terms of, and that if you would have invested across the value chain of smartphones, you would have outperformed broader markets like the MSCI. So that's what Megaforces are. Shifts changing the way we live, work, and how we spend money. And that should drive out performance through time. We think we've identified the Megaforces today that over the next handful of years or more can help provide clients with that level of outperformance. So we've identified 5. Digital disruption and artificial intelligence is one. Demographic divergence is the second. Geopolitical fragmentation is the fourth. The future of finance is the fourth. And a low carbon transition is the fifth. And again, we think that there's a clear line of sight as we move forward that those over time we'll see accelerated capital expenditure and meaningful performance potential from those in the context of client portfolios.
What is the identification process of those 5 forces look like? Right? Is that something that you guys sort of get in a room and brainstorm? What do we think the next leg of growth for let's just broadly say the U.S. economy and the global economy is going to be? Or is it sort of, one gets identified, some time goes by, another one that's really substantial gets identified, and then slowly over time, you guys are like, well, we got 5 of these on our hands.
Yeah.
What does this look like going forward?
Yeah, and this kind of concept predates my time with the team, and they've evolved slightly over time. But I often get the question, like, kind of similar in vein is similar vein of like, how often do they change? Well, not that often. Otherwise, they're not Megaforces.
Yeah,
right. Otherwise, they're kind of like trends or things that are popping, which is also a discussion we can have. But so we have our BlackRock Investment Institute, which have partnered very closely with our team. That they're doing really tremendous and robust market research. But a lot of it is we look for things that are underpinned by kind of structural forces, things like regulatory drivers, economic drivers, societal preference drivers. So it's part of it is a robust data process, and then part of it is also sort of what I would call having some very, very experienced folks that have been in capital markets for a long time that are able to identify things and make some calls that are supported by the data that we think these things will structurally change kind of the scope of how we're moving about our lives.
Mm-hmm. Well, everyone's talking about AI nowadays.
Yeah.
Let's save that one for last.
Okay, sure.
So we'll
and we don't have to go too deep in that. I think
Yeah.
there's some interesting nuance in how we see the world, but we can certainly save that for later.
Yeah, for sure. So the second one was demographics.
Yeah.
I think when you think about the U.S., from my point of view, you don't think that, demographics really play much of a part in how the U.S. economy works and how people, and, who is really driving, growth, who owns a lot of the stock out there. And when I hear demographics from the get-go, that's sort of how I'm thinking about it, right? Those from that point of view. Dive a little bit into, sort of what you guys mean by demographics and why that's something that you're paying attention to.
Yeah, sure. And I'll even maybe take a quick step back too, because I mentioned the 5 Megaforces. There's sort of an undercurrent that's another really interesting. We talk about like forces and focus, right?
Mm-hmm.
That's a fun little alliteration. Like infrastructure, and we talk about that later, but I just want to backtrack for a second. Infrastructure is another really cool play that actually gets supported by all 5 Megaforces. Maybe we talk about it later if you want,
Yeah.
But I wanted to kind of caveat that too, that's a really cool as we think about forces and focus. But let's focus on this idea of demographic divergence. So what that means, the way we're viewing it. So first off, let me start with this. Demographics are the single most reliable predictor of economics, right? Like that's I think really, really key to understand. Demographic divergence, when we look at developed markets, I think plus China, we tend to see a population that is aging.
Mm-hmm.
We tend to see a workforce that's getting smaller. When we look at more emerging economies, typically we see workforces that are growing and populations that are growing. That's the demographic divergence component of those things. That has a couple implications, I think. Number one, and this is where I think demographics tend to be a really reliable predictor. When you get older, you spend more money on certain things.
Right.
One of them is healthcare.
Right.
When you hit the age of 65, statistically, you spend twice as much money on healthcare after 65 as before. Yeah. And this is actually where I get excited because two megaforces collide. We have AI and kind of like technology intersecting with medical innovation. Because we're going to see demand for healthcare just go up dramatically in your aging economies. But what's also is interesting is some of these emerging economies, as we're seeing that growing middle class, there's a higher demand for healthcare because now folks can afford it. But what's cool is now you get some really interesting dynamics happening around medical innovation. Let me tell you a couple stories because I think these help folks wrap their heads around it. So like, for example, diagnostics is a great example. I actually think it was local, if I remember the story right. I think Mass Gen Hospital and MIT partnered together to build an AI model to help diagnose breast cancer. So if a doctor were to put in 2 separate mammogram scans, kind of like time 0 and time 1, that patient would be deemed low, medium, high risk. 88%, if I'm remembering my stats correctly, 88% of those patients that were deemed high risk contracted breast cancer within 5 years. Bummer that we're talking about breast cancer, but like when you think about that technological breakthrough, what oncologist wouldn't want that technology in their practice to help identify the potential future health issues for their patients and be able to partner together around how to go on that journey together. I mean, the demand for technology like that in medical practices, I think, is just going to be remarkable. And then phase step 2 is how do we treat these illnesses now? So I think it was 2 years ago, scientists for the first time ever mapped the full brain of an adult animal. Any guesses what animal it was?
Land or sea?
Land.
I want to say a dog, but I don't think that's...
Not a dog.
No. Elephant.
Smaller.
Oh, small?
Smaller.
Cat.
Cat, smaller.
Smaller. A rat.
Smaller.
A mouse.
Fruit fly.
A fruit fly.
Fruit fly.
That hasn't been done before.
They mapped the full brain of an adult animal. It was a fruit fly. And again, listen, a fruit fly probably takes up about that much space in the universe. They mapped 150,000 neurons in the brain of this fruit fly. Yeah. So now they're using that. They're using AI. Again, they're using technology, medical innovation coming together to help solve the problems that demographics are presenting. They're mapping the human brain 50 to 100 times faster. They're now mapping the human genome at paces they couldn't imagine before. You think about immunology and genomics, right? Manipulating our immune system to deliver better outcomes against diseases, or genomics, understanding our DNA. You can take a simple blood test now and help tailor which treatments your body will respond to best. So if you can now diagnose things sooner, and you can have more tailored treatment using genomics and immunology through this artificial intelligence innovation, you're going to deliver life-saving, life-changing patient outcomes from these things. And like the last one is just pharmaceutical drugs. It's another great example. I mean, it takes 15 years, $2.5 billion, and like a 10 to 15% success rate to bring drugs to market. With AI, those drugs are coming to market twice as fast and at half the cost, and at a much higher degree of success. Yeah. So you're bringing, again, life-saving, life-changing drugs to market at hopefully lower cost for all of us. But because pharmaceuticals can now keep their profit margins and maintain shareholder value. So medical innovation is really impacting demographics, I think, in a pretty meaningful way. So those are a couple of the things that I might talk about around demographics. There's some country implications to those too. Again, I mentioned, for example, China, one of the largest, I think still most populous country today, not for long. The one-child policy that was introduced years ago. I don't know if you have kids. I have two. We often translate or transfer some of our own life experiences onto our kids. So what the rocket scientists that did the one-child policy, that wasn't part of the math, was the psychology of it. And now you have individuals who are becoming parents today that were the product of a one-child policy that are now choosing one child because that's how they grew up. They had a great childhood, and they're kind of just passing that along. But what that means is you're going to see like 140 million people age out of the Chinese workforce over the next 15 years. By the end of this century, the Chinese population, hypothetically, if the trends continue, could go down 60%. You could go from 1.4 billion to 600 million people. Wow. What's the math on GDP? People times productivity. Yeah. So there's a lot of headwinds, I think, facing China. Whereas India, for example, that's when you talk about demographics, totally different story. Right. They're the second, maybe the first. I haven't checked the numbers lately, but most populous country in the world. But 2/3 of their population is under the age of 35. They're a highly qualified workforce, and the government has done a great job of incentivizing both domestic as well as foreign direct investment there, along with the technological innovations. Plus, geopolitics. I mentioned that geopolitical fragmentation. India is one of the few nations that has positioned itself, I think, in a very multilateral position where it's working very well with what I'll call the Western Bloc as well as the Eastern Bloc from an economic perspective. Yeah. So the prospects from an India lens, I think, are pretty are positive. Much of that being driven by demographics, but also I think given an extra kicker in terms of tailwinds by where they're positioning themselves in the geopolitical landscape.
Their middle class is growing pretty quickly too.
Pretty dramatically, and which is causing urbanization. Talk about demographics driving infrastructure. Yeah. That's a whole implication. Again, we can talk about infrastructure because I think that's cool because it's being supported by 5 megaforces. But that's another. Talk about the middle class coming in from rural communities into urban and suburban communities, which is driving a lot of economic growth there as well.
Let's go there. And I think India is going to knock off China as probably the most populous country.
I think so. I would think. By the way, our view is India moves from the 5th biggest economy to the 3rd biggest economy by the end of the decade.
So ahead of them would be the U.S., China, the UK,
Germany,
Japan. Okay.
I think it's Japan then Germany, but those would be your top 4: U.S., China, Japan, Germany. Okay. Then India. India probably passes Germany and Japan in the next 5 years.
Interesting. All right. So infrastructure. Where do you want to start? I say it like that because when most people think of infrastructure, it's my mind goes to the classic, just roads, highways, telephone systems, whatever you want to think of, sort of just that classic sort of infrastructure build out, something that the utility sector would benefit from, some energy companies. But is that how you guys are thinking about this, or are you thinking about it, more digitally?
Both.
Okay.
So, and that's where I think there's these cool kickers and these cool tailwinds around infrastructure. So when you think of infrastructure, right, it's kind of like what you talk about. It's energy, it's transportation, it's water and waste, and it's the digital infrastructure as well. There's kind of all of those kind of components, or I don't call them silos, but components of infrastructure. And when you think about the different drivers, right, so we talked about demographics. So you have developed economies like America, Western Europe. We're living on infrastructure that's decades, if not centuries old in some cases. Yep. So I don't know if you had this saying when you were in school, C's earn degrees. I don't know if you ever heard that before.
That's what I lived by.
All you need is a C, and they'll give you your diploma, right?
Yep.
Now, I don't know that that's maybe what we strive for when it comes to infrastructure. Right. However, 4 years ago, every 4 years, the American Society of Civil Engineers puts out a report card in the United States. We got a C minus 4 years ago, which was an improvement because we were a D plus 4 years before that. March 25th, mark your calendar. That's when the report card comes out this year. 1 in 13 bridges in the United States, of the 400,000 bridges we have, 1 in 13 is structurally deficient. So think about that next time you're driving over a bridge. So we need to repair in the U.S. and kind of Western society what is an aging infrastructure kind of layout, roads. And what's great when you talk about geopolitics, doesn't matter if you're conservative or liberal or you're from the north or the south, the east or the west, everyone hates potholes. Everybody hates potholes. So it is a rare area of geopolitical alignment in the United States, whether or not politicians want to admit it. We don't have to get too political, but it's an area of geopolitical alignment.
Yeah.
And then when you go to, like I mentioned before, emerging economies, you need to build out these huge cities like you talked about. You need to build roads. You need to build sewage. You need to build the power grid. You need to build homes. You need concrete and steel. You need to build the broadcom, the telecom. You need to build all that stuff, right? So there's huge needs in the emerging economies while building new. So we're repairing old, building new. That's kind of like demographics. I mentioned geopolitics. You get some support because everybody hates potholes. Everybody wants the light to turn on when you hit the switch. Yeah. But the other component is building out your infrastructure, whether physical or digital. At this point, geopolitics have rewired supply chains. Before COVID, it was all just about low cost, low cost, low cost. Those are the top three priorities: low cost, low cost, low cost. After that, it became about resilience. And part of that resilience was bringing supply chains closer to home or on our soil. And the previous administration used a bit more of the incentive or the carrot approach. This current administration looks like they're using the stick approach, whether it was incentives or maybe tariffs. We're seeing a U.S. manufacturing renaissance in this country that started with the last administration. I think will continue with the current administration. So you're going to see rebuilding of factories. You're going to see retrofitting of old ones. That's all supporting this infrastructure build. So you kind of have demographics, geopolitics. You talk about AI. We're going to see, I think the number that we're looking at is $3 trillion over the next 5 years to build out data centers, GPUs, servers, cooling equipment, the power grid. So that's supporting this massive infrastructure build. It's the digital and artificial intelligence wave. The pie for power is going to continue to grow, particularly as we grow this artificial intelligence. AI today, AI data centers are about 5% of U.S. electricity consumption. That could double, or in some cases, in the bullish cases of AI, quadruple over the next decade plus. So we're going to need more electricity, and guess what? When you turn the light switch on, nobody cares what source it came from. They just want the lights to go on. Right. So I think renewables will continue to grow, even though we're going to see fits and starts along the way. I think currently maybe in the U.S. here a bit of a fit. And then just the future of finance. One of the pieces of the future of finance is both public and private markets. We like to say in the U.S. we're number one. And we certainly are when it comes to debt. So some of the public funding may not be as robust, but this is where the private market comes into play. Yeah. And you're going to see a really, I think, interesting mix of public and private access to the infrastructure space. So that's how all 5 megaforces are supporting infrastructure. And the way I sort of think about it, if you own a home and there's a storm and your roof gets damaged and now your roof's leaking, you might have been like, man, you know what? I really wanted a pool. I would love to put in a pool, but I need a roof. Yeah. So regardless, this is a need, not a want. And I've seen estimates from $15 trillion globally over the next 15 years up to $75 trillion. I think Larry Fink, our CEO, said that, and I think it was the Financial Times. I might be misquoting the source there, but I think he said $75 trillion over the next 15 years, which if you just think about that spend, it's pretty remarkable. Yeah. And that's why we think that there's some pretty interesting opportunities from an investment lens in the infrastructure space.
Interesting. That's so we're tippy-toeing around AI. Let's just go right into that.
Sure.
From a broad point of view, how are you guys thinking about AI? Right. I mean, you can think about it from. Do you think it's going to? Are we going to see enhanced productivity because of it? I think that's maybe a standard view that people have. Some people also think that we might not, right? Because it might remove more jobs than it enhances. Yeah. You touched on healthcare, how it's affecting the healthcare space. I personally think healthcare is going to be one of the first benefactors from the build out of AI, and I think that's fantastic, right? Because everybody wants healthcare to innovate and grow as rapidly as it can. For sure. But dive into that a little bit, right? How are you guys specifically thinking about AI?
Yeah, this is a big pool to swim in. So let me think how to slice and dice the conversation here. So first of all, with AI, let's talk about kind of, I think, what the rollout could look like, or kind of the future. So the phases of AI, kind of big buckets here. There's build out. You got to build the tracks.
Yep.
Then there's going to be the adoption phase, and then there's the transformational phase. And we are still very, very squarely in the build out phase of AI. We're starting to see offshoots of adoption, medical innovation, customer service, et cetera. Legal practices are leveraging AI. But I would say it's only scratching the surface.
But build out's not even, that's never going to be finished. It's always going to continue to just evolve over time, right? I mean, like you think about infrastructure, we're talking about that. We've never stopped updating infrastructure in the country.
That's right.
Maybe in certain parts of it we have, but it's just always growing with the innovation in whatever particular.
Yeah, I think that's right. I think you get to a point where you get to like mass, critical mass.
Yeah.
Where it's like, okay, now we can in meaningful way move to enterprise adoption and individual consumer adoption. I sort of use sometimes the story of the Transcontinental Railroad as kind of an analogy. So that started in 1863. I think at the time it was like $50 to $60 million of total investment, which today is like $2.5 to $3 billion of investment. But 6 years building the tracks, all 1,776 miles of track. I think that was intentional. 1776, 1776 feels patriotic to me. I don't know, but and in 1869 when they hammered in the last spike. It's a cool story. They actually attached telegraph wire. I don't know if you know the story or not.
No, I don't.
Attached telegraph wire to that last spike, and when they hammered it in, it sent a signal to San Francisco and New York to cannons, and it shot cannonballs into the Pacific and the Hudson River, indicating this new economic era the United States would go in. But the point was, like, you had to build these tracks before you could send a single train across it. And you spent today $3 billion of investment without a single dollar of return for 6 years. Like, that's kind of where we are now. We've certainly seen some returns in certain spaces, but it's largely that build phase. And then once the trains were done, all of a sudden, you were shipping freight and people across the country. It's 90% reduction in the cost to go from one side of the country to the other.
Right.
Today, I think it would be like $3,000, $30,000 to go down to $3,000 across the country. And you started sending $50 million worth of freight back and forth every single year. $50 million was the cost that it was to build it at the time. And that's where we get into adoption. You start using this thing, you start seeing that economic value. And then the transformation stage, which is next, which is like we don't know what that's going to look like. The transformation stage for the Transcontinental Railroad was, I think, 7,000 towns, depots, and cities were built on the Transcontinental Railroad along the way, right? We didn't know that. And I think, I might be misquoting this, but it's a good story being from Philadelphia. Kansas City was one of those cities that was built on which we appreciate in the last Super Bowl, them being our opponent. I had to throw that in there. I couldn't help myself being from Philly. But the other thing was, it was the Victorian age Amazon, which was the mail order catalog, was built from the Transcontinental Railroad. And our lead tech investor, Tony Kim, who's our fundamental technology investor, thinks that artificial intelligence is going to underpin all the technology we use, 10, 15, 20 years from now. So that transformational phases, we're not even sure the impact that it'll have. But yeah, I think the point you made was we're in the build-out phase. We're probably not going to stop building, but we need to build that critical mass so we can actually get trains across the tracks. And that's where we are today. And, we're going to see, over the next 5 years, I think, we had $200 billion, a little over $200 billion of investment last year. We're going to grow to $700 billion annually by 2030, just investing in data centers, like the semiconductors, the power, the cooling, all of that stuff. And then we start to move into adoption really over the next 2 to 3 years, where we start to see more integrated artificial intelligence in what we do. The question you asked is, does it start replacing jobs? The employment landscape will absolutely shift. Will it replace all jobs? I've seen different reports saying, it could make certain jobs more efficient, allowing you to do, the same amount of work in less time. Some estimates say that in a law practice, AI and a very specifically generally built out AI model could take up 25% of a lawyer's tasks. Does that mean 25% fewer lawyers? Probably not. But I think it means that lawyers spend time doing things that really only uniquely trained humans can do. Sitting across from a client, solving complex problems, being in a courtroom.
Right.
But the employment landscape will shift. Before the first industrial revolution, 50% of our economy was, and when I say economy, the jobs, were agriculture. Today that's 2%.
Yeah.
Those people didn't stop having jobs, they had different jobs.
Right.
The other piece of it is we talked about demographics. Demographic is coming down. So if you want to keep your GDP growing, if you have fewer workers, worker time productivity, AI can hypothetically offset some of that lack of productivity by the number of workers.
Yeah.
I've seen some estimates that AI could generate just 1/10 of 1% to GDP. To more bullish that it could generate 1.5% of GDP growth through additional productivity. So anyway, that's how we're going to roll these things out. We're very square in the build-out phase. We'll move to adoption and then transformation, maybe in the next 3 to 5 years, and then beyond for transformation. But what that means is when you look across the AI, the technology stack, as we like to call it, that's going to create kind of shifting opportunities as we move through this rollout phase. The tech stack as we see it today is the digital infrastructure, kind of like I talked about, right? Power, cloud, data centers, et cetera. There's the intelligence layer, which is the models and the data, the companies that own the proprietary data that they can monetize. And then the third layer, the high layer, is the apps and services. It's how we're going to interface with AI over time. And today we think the biggest opportunity still continues to sit in that infrastructure space. Okay. As we start to get into the adoption and the monetization, we start to move up the stack in terms of where we start to see the investment and the real, the opportunity for investment returns as well.
Interesting. What is the viewpoint around whether we're going to see new jobs created from AI? So, for example, an analogy I like to use is when the iPhone came out, obviously people thought there's going to be jobs that are going to be replaced from that, right? It wasn't going to be drastic, like we might be looking at now, but we certainly didn't see the amount of developers, right? That's that cohort of the economy that would grow from the introduction of the iPhone. Yeah. Right. There's a lot of developers now. There's thousands and thousands of apps, and there's teams of people behind each of these apps. Right. That certainly wasn't anything that we really thought would probably reach this magnitude back when the iPhone came out. Are we going to see something similar with AI, do you think? Or are we going to see parts of labor parts of the economy arise that don't exist today?
I think the short answer is yes. Yeah. And it's kind of like, hey, what are your known unknowns, right? Like that's a weird question. Yeah. But I think the short answer is yes. I think we're going to see parts of the economy emerge that we didn't know about. You talk about the iPhone, right? The smartphone evolution. I don't think Steve Jobs would have thought that we'd have a $24 billion online influencer industry where people are just hanging out of their house and videotaping themselves and selling the coolest new water bottle or whatever it is. Right. But that's a whole industry that didn't exist. 18 years ago now, whatever it was that we saw this smartphone. I mean, social media, that didn't exist in the robust fashion that we see it today. I mean, Facebook was, it started when I was in college. I'm dating myself now. Well, I guess you did in the beginning, calling me one of the early employees of BlackRock. But, Facebook came out when I was in college. You needed a college email address to have Facebook back then. And now, you need to be at your computer. Now you can be on it anywhere you want. I think the point is that we'll see that employment landscape shift. We'll see new jobs, new industries emerge. I forget the source. I'd have to look back. But I think I read it in a USA Today article. I forget the source, but there's estimates that we could see up to 12 million net new jobs created as a result of artificial intelligence.
See, that doesn't get as much attention as it should.
It doesn't, because fear-mongering sells papers. But listen, I don't know if 12 million is the right number, but if the idea being that net, we see new jobs. Now, most of those will probably be in the more technologically based space versus other things. So there may be a reskilling of workers, but that's happened throughout history. Again, I date myself, but I never cried over the cassette tape manufacturers and DVD manufacturers going out of business because I like streaming my music instead of sitting by the radio waiting to hit record on my tape recorder like I did as a kid waiting for my favorite song to come on. The employment landscape will shift. New jobs will come up largely in the technology space. But again, that transformational phase is, we don't know how far the reach or the extent of artificial intelligence will change the way we live, work, and how we spend our money. But we know it will. And
we've already seen that happen. You see, friends of mine have their kids that are being taught how to code nowadays, and that's been going on for a few years now. So that's just going to continue to evolve.
I think so.
Yeah. Right? Nobody, when I was in elementary, middle school, nobody was being told how to code.
No, we were learning how to type.
Yeah, exactly. And now everybody knows how to type.
Yeah, and the funny thing is, we talk about coding. Coding is, I think, going to be really important because somebody has to write all of these programs. But you're going to see AI code. Yeah. AI is coding today. And sometimes what it's doing is it's writing code, but you need a very skilled coder and engineer to review the code and make sure that it's actually, we always kind of say at BlackRock, it's the human to the power of technology. It's not going to be human or technology is greater than human. It's human to the power of technology. But the technology is getting more and more powerful, so you're starting to see a lot of pretty cool changes.
Yeah, that's awesome, man.
Yeah,
I'm looking forward to it.
it'll be fun.
Yeah, so it certainly will. And it's going to affect our industry too.
Yeah, I mean, it already is. I mean,
Yeah.
we have investors at BlackRock, our BlackRock systematic investment team.
Yeah.
They've been using artificial intelligence, certain models of it to help their investment process. Not replace. We have portfolio managers, humans that are trained investors, but they use a quantitative process. They use big data, large language models, and artificial intelligence to go out into the world and take unstructured news or kind of alternative data that typically doesn't come in a balance sheet or an income statement from a company, and they're using it and they're using these models to process this data to give them signals and insights on where opportunities sit in the market, maybe in a way that's faster than your typical kind of person just sitting looking at Bloomberg screens.
Yeah.
Some of these themes and trends emerge in real time. Like I remember coming out of the global financial crisis back in 2008, 2009, and our systematic team talked about. So the U.S. kind of was ahead of the Europe in coming out of this crisis, and they were using these quantitative and these big systematic approaches. And they're looking at European search history, and as they started seeing Europe search for bigger purchases, new appliances, new vehicles, they started thinking, okay, maybe Europe's starting to emerge from their recession. They put an overweight to Europe. Based on that, and like 3 to 6 months later, you started seeing those Google searches turn into purchases, and they really benefited. And that's one of those examples of being able to see things in real time using alt data that's really hard to extract at the human level in mass or at scale. So it's impacting our industry from that perspective, or the cybersecurity lens is another way that you're starting to see AI and technology in our industry, making sure that we're protecting our client data. Those are all really, really big implications, I think, to our industry right now.
Yeah. Are you guys looking at cybersecurity in a similar vein as these megaforces?
Cybersecurity falls right into those megaforces.
Yeah.
Again, it's another collision of megaforces. It's geopolitical fragmentation and and artificial intelligence. That kind of actually leads into this conversation around geopolitical fragmentation. I mean, really from the end of World War II up until about 2016, at least what the data tells us, is we're on a one-way escalator ride towards globalization. Better economic relationships, better diplomatic relationships, the movement of information and goods across the globe. And then we saw data, really a retrenchment in 2016. We saw kind of populism arise in certain developed economies. As we continue to move forward, we saw things like COVID, now the war in Ukraine, the conflict in the Middle East. All of these things are creating more and more distrust, pushing our adversaries further away, bringing our allies closer. I think we were. I don't know if we're still bringing our allies closer. I was in Canada last week. I didn't get booed like they did at the hockey game like a month ago, but I can tell you there's some tension even with our neighbors to the north. It was all good fun, but that distrust has resulted in, I think, a handful of implications, but in this lens of cybersecurity or defense is what I'll call it. There's two battlefields today. There's the physical battlefield, like I said, we're seeing in Ukraine and the Middle East and other places, but there's the digital battlefield, and more we're finding the battle taking place there. I talked about AI, before. The fuel for AI is data. And if AI is going to change and revolutionize kind of the way we live, work, and spend our money, data now becomes one of the most valuable commodities on the planet. Yeah. So I think since COVID, we've seen cyber attacks increase 300%. I think it's McKinsey that estimates that this year we'll see the damage from cyber attacks top $10.5 trillion. That's up from $3 trillion a decade ago. So we're seeing 3x the financial impact of cybercrime. There's I have to find the website, this great visual that goes back maybe like 2 decades, and it just kind of shows the real estate, and then it has little dots where cyber events have taken place. You can hover over it, it'll tell you what happened, what the impact was, and it's mostly white space. A decade, 2 decades ago. And then as you migrate, through time, the space gets filled with bubbles. And then as you continue to migrate closer today, it's more bubbles, and the bubbles are a lot bigger. Because these bad actors now are using the cyber battlefield, the digital battlefield, sometimes more frequently than the physical battlefield. Yeah. So cybersecurity, the investment we've seen in cybersecurity, last year I think it was $225 billion, which was a record. We're anticipating a 10% increase. We should see something like $250 billion spent on cybersecurity globally this year. Yeah. On top of what we're spending, I think last year was $2.4 trillion on military defense, and I don't think that number's going down anytime in the near future either. Whether it's helping some of our allied nations across the globe or just continuing to fortify ourselves against those adversaries that we're pushing away from this geopolitical tension.
And there's definitely cybersecurity spend within that 2.4 trillion for military.
Oh yeah, that's
so there's overlap too.
100%. I mean and like AI is part of the military. What they're doing, they're thinking about AI using drones and using like being able to scan like infrared detection and all these things to like scan landscapes and scan topography to find abnormalities of where people might be. So there's a lot of this stuff that is like interwoven with one another. That's why I get excited when Megaforces collide, because I think it creates this really, really fascinating story and investment case for how these things can impact portfolios. Let's
talk about geopolitics.
Yeah.
And I know we
touched on it a little bit.
Kind of just did. But what do you guys mean by that when you say geopolitics? Or we're talking about demographics, right, and aging workforces in some parts of the world.
Yeah.
How does that differ from geopolitics? Right, I feel like they kind of have their own little intersection.
Yeah, and a lot of these megaforces intersect in some places with one another. There's a big Venn diagram that we could draw, like where these things intersect. But geopolitics, we kind of talked about like globalization and kind of this pullback, and as we think about geopolitics, it's the economic and diplomatic arrangements that we have with fellow countries. Like tariffs is one of the big ones that's happening today, right? Yep. Whether it's being used as a negotiation tool, I think there's all these conversations: is it bluffing? Is it not bluffing? We turn them on, we turn them off. But that's a component of geopolitics. Is how we're engaging with our neighbors and our or adversaries, right, in financial and diplomatic ways. So what's happened, I think, is we just like gotten to a place where the tensions or the frictions around working together have gotten more, like just more tension, more friction. Yeah. It's making it harder. And you're seeing things too, like some of the other implications of geopolitics. We sort of talked about technology, this onshoring of factories. Yeah. Talked before about building new or kind of retrofitting old. That's part of it too, because we want to simplify our supply chain, so we're not at the mercy of other nations. Do you know how many borders a semiconductor crosses in the whole manufacturing process? When
it comes from Taiwan?
Well, so like they oftentimes get manufactured in Taiwan.
Yeah.
But like, how many borders does a semiconductor cross in the entire? We're talking about like raw materials to processing to doping to the manufacturing design, all of that, right?
15. Yeah, way higher.
4x that.
Yeah.
Right. It's crazy.
Yeah.
So there's this tech independence movement that we're seeing in the U.S. too. Not only like the physical supply chain, but the digital supply chain. Which Taiwan Semiconductor manufacturing company, they're going to be investing. I think it was $100 billion we saw a couple weeks ago. Yeah. Building fabs in Arizona. The Chips and Sciences Act from the Biden administration, it's $50-odd billion plus incentives, $53 billion in grants plus incentives. We've already seen that trend, continue. Like Taiwan was building another fab in Arizona already. Like that's a big deal.
Oh yeah.
For the global supply of semiconductors, which are the powerhouse for the whole underpinning of AI.
Everything.
So that's a real geopolitical risk. I don't know if they will, but that's a risk, and that's why you're seeing geopolitics impact things like demographics, or impact things like infrastructure, and impact things like AI. So all of these things permeate each other in a really interesting, kind of complex way.
Interesting. Let's touch on the last one. Actually, there's two more. Let's touch on these real quick. Digital assets.
Digital assets. Is
that, when you say that, you guys referring to cryptocurrencies?
Yeah, that's kind of the new industry standard for cryptocurrency. Yeah.
Dive into that a little bit. It's become, we just had the Bitcoin Strategic Reserve. Yep. I think that was announced not too long ago. Yep. We have a crypto czar in the government now. Dive into your viewpoints there, and why that's become so important.
Yeah. So, and for the viewers and the listeners, let's like maybe take a step back and just talk about kind of the journey of cryptocurrency. So, Bitcoin was the first cryptocurrency invented, if you will, back in 2009. And the purpose of Bitcoin was for individuals to be able to transact value virtually instantaneously and at near low cost and without an intermediary anywhere in the world. That's what it was designed to do. Because there are some inherent flaws, if you will, or challenges with fiat currency or kind of government issued money, right? Things like it's hard to transact over borders. If you want to send money from one country to another, you could see a 5% remittance fee on some of those things. Countries, and I think we know this very well, can inflate their currency. They can just print more and debase that money. So there were problems that were identified with the current money system. And Bitcoin was kind of meant to address those issues in a digitally native format. And it does that. Now, I think we all live in a country today, while inflation's a real thing, like we can take our credit card and go spend money at the grocery store here, or if you want to go on vacation, I can spend my credit card in Spain, no issues, right? Not every country is like that, where you can just take your currency or your credit card or your financial capability anywhere in the world. 70% of the population lives under autocratic regime. So it's also subject to censor and seizure, right? But what's ended up happening is because Bitcoin has this dynamic of being a global, non-sovereign, decentralized asset, it's taken on some really interesting properties. And what I mean by scarce, too, let me explain that. So there is a finite number of Bitcoin, 21 million. I think we're somewhere in the neighborhood of 19 and a half. The last Bitcoin, I think, will be mined in 2140. So we won't be alive, probably, unless medical innovation and AI gets us there. But what that means is there's a predictable path to mining new Bitcoins, which means you can't debase the currency, you can't inflate the currency, like you can just turn on the printing press at the Treasury and go. So that's what I mean by scarce asset. Because it's global, non-sovereign, decentralized, and scarce, that has similar characteristics to something like gold. And in fact, what we've seen over time is the infrastructure for digital assets has matured. We've seen more regulation, and when you've been regulated, you've made it. So Bitcoin's been regulated; it's now a real thing. And as we've seen more adoption, it's actually sort of on this glide path to a digital gold, from the idea that it hypothetically could be a store of value. Now, listen, it's very volatile. We'll talk about that, but it has served over time as a really interesting hedge against monetary debasement, inflation, and harkening back to our previous discussion, geopolitical risk. Now, it also solves some problems of gold because you can transport your Bitcoin on a phone anywhere. It's hard to bring like gold bars because they're really, really heavy. And by the way, if you bring gold bars over borders, people are gonna ask questions. So it's the transportability, like the saleability of Bitcoin, all solve some of those problems as well. So anyway, that's like a little bit of like the background of Bitcoin specifically. Ethereum is a different animal. We don't have to get too much into that, but that blockchain technology is much more complex than Bitcoin. Bitcoin is the blockchain technology, which is just, I'm going to use the cardinal sin, I'm going to use the words to define the word. The blockchain is just blocks of data that are linked together in a chronological chain, and once they're produced, they can't be changed. They're immutable, they're permanent. Bitcoin's blockchain was literally just meant to be a digital public ledger to track Bitcoin transactions. It's a feature, not a bug, that it's simple. Ethereum is very, very different. I almost think of that as sort of like your iPhone, iOS, your operating system, or your app store. And then you can write apps on top of it. You can download apps onto your phone through the app store. That's kind of like Ethereum. It's one of the most used software writing platforms on the planet, mostly for decentralized financial purposes. But anyway, we don't have to get into the details. But so Ethereum also becomes kind of a different animal because it's more bet on blockchain technology and like the kind of like a VC of crypto, if you will, venture capital versus Bitcoin, which is sort of that like digital gold type of investment thesis. And what we've seen is, you mentioned like we have a very crypto-friendly government today, both in the White House as well as Senate and Congress. Crypto czar, we have the crypto reserve coming. So one of our theses, if you will, behind cryptocurrency is that we continue to see increased levels of demand in what is a finite and limited supply area. Econ 101 tells us limited supply, increasing demand, that's beneficial for pricing. So like what's letting us think that there's going to be more demand for this stuff? We've now put cryptocurrency inside an exchange traded product. So now individual investors who maybe were overwhelmed at opening a crypto wallet or didn't fully understand how to do it, now in their current brokerage accounts with their financial professionals can access cryptocurrency inside of their existing accounts in a packaging and a wrapper and a vehicle that is familiar to them. And once that turns on in a really meaningful way at the broker dealers, we haven't seen a huge turn on yet. But even this week, not to mention any names, but we did see a major broker dealer approve our specific cryptocurrency as well as a couple others, the exchange traded products on their platform. And as we see that come on in scale, I mean, we're talking about trillions of dollars of investor money that now hypothetically could be unleashed into this space. So there's some pretty interesting tailwinds from a demand perspective in the cryptocurrency space as we move forward from here. And listen, it has, I'm not saying it's for every client, But certainly when we've done some research and putting it in portfolios, it does a pretty interesting thing because it has a low correlation to stocks and bonds. So even though it's volatile, and by the way, like the volatility has come down pretty meaningfully since 2018. Volatility has been cut almost in half. Recent spike in volatility, over the last handful of weeks, but volatility is always a moving target. Sometimes the stock market volatility has creeped up too. If you look at the VIX today, but vol's been cut in half. It's kind of in that 50% range of standard deviation, which is not that different than some of the Mag 7 stocks. So what that tells me, if your Mag 7 stocks have the same volatility as Bitcoin, it's not volatility that's keeping people out of the space. It's lack of understanding of the space and what it means from an investment point of view. Yeah. But the correlation over the long term has been about a 0.2. So when you introduce something like that into a portfolio, when you have a low correlation, you start to get more efficiencies in the overall portfolio, which is what we found in small doses. Bitcoin's kind of like ghost pepper sauce. A little bit goes a long way.
That's a good little analogy.
Yeah.
So the introduction of the ETF really blew the door down.
It really did.
That's that's if that never happened, then the thought process going forward around the space would probably be completely different.
I think so. Yeah. And January 11th of last year, 2024, is when these exchange-traded products came out. There was 11 firms that launched spot Bitcoin, meaning you give us $1, we go out and buy $1 worth of Bitcoin. Before that, you could buy Bitcoin futures, Ethereum futures. And so we came out with the Bitcoin in January and later last year. I think it was May. I might be wrong there. We came out with the Ethereum in the industry. And I think the number is probably stale now, but I think the number was something like $120 billion across the industry got raised by investors in the spot Bitcoin exchange traded product landscape. So that's like in a year. You saw 120 billion. Yeah, it was the fastest growing space.
It was the most successful product launch ever.
In history, in history. Yeah. And again, I think that changes the landscape. I think it changes the view. And I think it changes the trajectory of this idea of digital assets in the context of a more traditional portfolio. Mm-hmm. Yeah.
Let's touch on low carbon.
Yeah.
Real quick. Then we'll dive into one other thing and wrap it up. Low carbon. That's in reference to the build out that we're going to see from infrastructure to power AI, all this stuff, right? We don't want more inefficient energy sources, right? We don't want more energy sources that are going to continue to pollute the world.
That's right. Yeah.
Right. So we're going to see these low carbon, clean energy sources continue to be built out. Give us a couple examples of those.
Yeah, I mean, so I think wind and solar are like really easy ones. Yeah. This next one I'll share is a fun story. I don't know if that's super scalable, but I think it was a Bitcoin miner. Because by the way, mining Bitcoin is a very power-intensive process. Mm-hmm. They built their mining facility in a volcano. Not in the but on the volcano. So they're using geothermal energy to power. So that's like a great example, right? But the other piece of this becomes power storage. So it's not just generating the power, but because some of the renewables like wind and solar are not constant. The sun goes down, the wind stops blowing. You need places sometimes to store power when you have an excess of it. So batteries and power storage are going to be, again, in our opinion, a really huge place, especially with the electrification. I probably botched that word. You know what I'm trying to say. The electrification of a lot of different things, whether it's vehicles, et cetera. It's just storing some of this power is going to be really, and that's like lithium, as one of the main sources of some of the batteries. The other big one that we're going to see a renaissance or revival is around nuclear. Yeah, I think there's 7 nuclear reactors around the country that are either being like turned back on or like ramped back up. Mm-hmm. And then you're seeing these small micro reactors that are coming up now, where they're small, they're portable, so to speak. Some of these are low cost. I'd say low cost, like 20 million instead of $1 billion plus for these micro reactors that can be used on site in individual places. There's still a lot of risk that comes with nuclear, but if done, and we've seen some issues in the past, right? But if done right, and some of these micro reactors will have a smaller scale of potential risk, with spillage and whatnot. I think I mentioned before that for these megaforces, we have this long-term view. We think we have a clear line of vision to long-term outperformance, long-term performance drivers. Fits and starts along the way. I don't know if you can picture the adoption curve, right? Like the S curve. Right, so I have like your innovation, your early adopters, you kind of like, majority adopters, and you get to the laggards are sort of like ubiquitous. The earlier on you are in the space, the more risk there are. But that's the academic line, right? That smooth S, right?
Yeah.
We never move in that direction. We're seeing in AI right now, right? We're seeing a kind of a pullback. DeepSeek, maybe threw a little curveball. We still think that long-term DeepSeek doesn't change the long-term trajectory. If anything, it maybe gets us to adoption more quickly. But you're seeing those fits and starts. So you kind of zig and you zag along that academic smooth S adoption curve. And right now, I think it's a zig or a zag, whatever you want to call it, in the low carbon space. But again, I think over the long term, we know where we're headed. So for the patient, the kind of discerning investor that wants to look to have strategic allocations in their portfolio to things that should drive that outperformance, these things can make some sense.
And I know BlackRock you guys have a maniacal focus on, helping clients and, investment advisors, build sound portfolios.
Yeah. Oh, yeah.
How do you guys think of the exposure to these, these megaforces and different themes going forward?
Yeah. So awesome question. So one of the things we're really lucky at BlackRock, and I talked about, the evolution since I've been there, and one of the things that's been a constant is Aladdin, which is our proprietary risk platform. We're very lucky at BlackRock. We consider ourselves a fiduciary to our clients. All we try to do is help them manage their money and manage their risk, and that's what Aladdin does. So while we're a high quality parts provider in terms of the investment products that we have, we want to help folks design that portfolio in a way that is deliberate, diversified, and scaled. Deliberate meaning your exposures and your risks are on purpose. Diversified meaning they're spread out, they're not all concentrated in one place, and they're scaled, they're sized appropriately. So we often like to say there's no right or wrong risk, there's no right or wrong exposure, it's just intentional or unintentional. So let's start with that. And I love the way you said maniacal focus. Like, that is so spot on. We have a maniacal focus on helping people build intentional portfolios. So when we think about this idea of thematic or mega forces and how they fit in the context of a portfolio, we actually did some really interesting research over the last year with one of our institutional portfolio construction teams. And when I say institutional, we're talking about like pensions, endowments, sovereign wealth funds, and like these big, billion, sometimes $1 trillion entities that are coming to us for portfolio guidance. And here's what we found: the headline or the punchline. If you took what are your 1, 2, 3? Thematic exposures are unique, they're rewarded, and they fit in portfolios.
They're unique to the.
Well, let me unpack those.
Okay.
Let me unpack that. Let me unpack each of these. So they're unique. What does that mean? So the way I think about thematic exposures is they're meant to be a part of the portfolio that's going to drive outperformance, right? So if you want to outperform broad markets, if you want to beat the market, you cannot be the market. So there's different types of risk underlying. I don't want to get too technical, but there's sort of explained risk, movement in price that you can explain either through like the broader market movement, country, foreign exchange, industry, et cetera. And then there's what we would call idiosyncratic or unique risk, or something that's just not explained by the measurable forces that we see in the marketplace. So again, if you want to beat the market, you can't be the market. When we looked at thematic exposures versus things like sectors or even value and growth styles, there's more unexplained risk in thematics versus sectors and thematics. Or said differently, you are less of the market. So if you want to beat the market, you can't be the market. This is less of the market. So it's giving clients more room for that outperformance. So said another way, thematic exposure or megaforces have what I would call unique sources of risk and alpha or outperformance potential. By the way, that unique exposure is irreplicable. So what is the process we did to see if we could replicate that? We took our iShares product line, and we took all the traditional ETFs that we have, non-thematic equity ETFs, and we tried to optimize a portfolio every single year to match that idiosyncratic risk, that unique risk of thematics. And what we found was in that active risk bucket, couldn't do it. Over the last 5 years, I think it was something like 2/3 on average of the risk couldn't be replicated. When I say risk, again, the drivers of price movement, right? Risk isn't a bad thing. You have to take risk to get returns. You can't steal second with your foot on first, as my dad always would tell me. So the idea is you couldn't replicate it with traditional building blocks. So thematic exposures have unique sources of return and risk in a portfolio that you can't replicate elsewhere. That's important. They're rewarded. If you look back over time at the unequivocal, undeniable themes of yesteryear, and I think we might have talked about smartphones a little bit.
Yeah.
If you look at the adoption of smartphones from 2007 through, it beat the MSCI by 1.5 times. If you look at e-commerce. So back in 1999, you started to be able to put your your home address and your credit card information on the internet, and it would ship something out to you, weeks later, usually instead of days later, like Jeff Bezos made us able to do. But that was the evolution. So if you go from 99 to 2023, we're like post-COVID, the e-commerce beat the MSCI by 4 times. It beat the tech index by two times. E-commerce sits in that broader tech space. So those are like your unequivocal themes of yesteryear. But those stocks that were kind of blip on the radar for investors 20 years ago are now the biggest stocks in the world. And they rode the waves of megaforces. So when you look back over time, megaforces, thematics are rewarded. And now let's get to this idea of they fit in a portfolio. So we talk about being maniacal about portfolios. So we have a team of individuals who works with financial advisors like yourself. And they will help them, advisors who are building kind of like models and have a process around building portfolios for clients, and help them have a consistent, disciplined, and repeatable process to make sure their portfolios are deliberate, diversified, and scaled. And we looked at 23,000 advisor models last year and helped them kind of be more intentional. And we took the 23,000 models we looked at. We rebuilt the composite kind of average advisor portfolio for a 60-40. And then what we did, we took that exercise and we looked at it and we said, okay, about 5% of those portfolios have sector exposures, right? Financials, real estate, technology, et cetera, utilities, those are your sectors, right? There's 11 of them in the S&P. So we say, okay, what if we replace that sector exposure with thematics? Just 5%, boom. An equally weighted basket of our 5 megaforces. And then we looked and we peeled away 10% from value and growth as well as international to create a 10% exposure. And then we simulated a cash infusion into the portfolio. By the way, do you know there's $8 trillion of cash on the sideline today for investors?
Yeah, it's a lot.
Yeah, maybe we're going to say 12. I don't know what the number. It's huge.
No, it's a lot.
It's huge. It's a lot.
Yeah.
So that's not like a crazy, investors putting cash in a portfolio. And we did a 15% weighting. So a 5, 10, 15% weighting, sourcing from sectors in scenario 1, style and international in scenario 2, and just a cash infusion, taking everything else down pro rata 15%. And we looked at the base portfolio, and we looked at these new thematic portfolios. Effectively, the top line risk, the top line volatility didn't change. It's the same. 40 basis points off to go from base to 15. That's the same. The investor experience is the same. But the underlying risk, remember I said they were unique? When you look at the active risk the portfolio is taking now, the portion of it that was unexplained or driven by this unique thematic exposure, this thematic sources of alpha, grew from 4% up to 20%, 21 I think the number was. So they fit in a portfolio because they don't change the total volatility, but they change the source of risk in a way that we think gives clients more runway for outperformance over the long term. So, as I'm sitting here talking about all these cool stories and this big growth, and folks are thinking about, okay, what does that mean for me? In our opinion, thematic exposure should be a piece of clients' equity exposure to give them a piece of their portfolio that's driving performance and returns into the future. And we're a big believer in we have a process, BBIM. It's, benchmark, budget, invest, monitor. It's a kind of your process. And when you budget, you have to budget risk and you have to budget your fees. And ETFs tend to be very low cost. And they tend, in this case, in terms of budgeting your risk, you don't have to give up anything, but the reward you can get for it is pretty meaningful. So you can pair that alongside of your active managers or your private exposures, et cetera, in a way in the portfolio barbell that kind of risk and that fee budget, I think in a really efficient way to create what I hope is really unique outcomes for clients.
That's awesome, man.
I'm really excited about the research. It was a year long we've been working on this with our team. And I'm really, really excited that we're now able to kind of bring this to clients and help them build, again, portfolios that are just a little bit more thoughtful. Yeah. And include thematic exposure.
Yeah. No, it's a great way to think about how you can participate in what's coming tomorrow.
Yeah, when you think about the next generation of growth and the next generation of, innovation, I think this kind of next gen approach, I think is really, really thoughtful.
Yeah, you want to skate to where the puck is going.
100%. Yeah. Instead of chasing it around like a lot of people do.
Right. Well, thank you, man. This has been great.
Yeah, this has been a lot of fun.
Yeah, this is fantastic. One thing I always finish up with is, I like to ask our guests, what's one thing that has stuck with them throughout their career? Could be, like a quote somebody told you, experience that you went through. Could be insightful, could be, sort of comical, but would love to hear what that is for you.
One thing that stuck with me throughout my career. So, couple thoughts here maybe. Number one, the mea culpa, the apology, I messed up, goes a long way. It shows humility, right? It shows partnership. I think I've built more relationship capital with I'm sorry I screwed up how do we make this right, versus all the things that I did really well for somebody. So like that mea culpa is really, really powerful. I think that's like first and foremost. The other thing is gratitude goes a really, really long way. And it's not, and for me, I think the gratitude piece is less of like up the chain of command. Mm-hmm. It's more left and right and down. I remember being like an early starter in my career, and when you got that thank you from somebody, it made you work a little harder for them, and it kind of endeared you to them a bit. But it's really, really meaningful. So I think the thank you is the big thing. And then the last thing I'll share with you is, so I grew up, I know when I walked in the room, I know you're a collegiate athlete. You can tell just looking at you.
Oh, yeah.
You wouldn't know by my stature when I walked in the room. I didn't play anything in college, but like I played, basketball and baseball growing up, and I probably shouldn't have played basketball. I probably should have wrestled. But, I was one of those guys on the court that like people didn't want guarding them. And one of the things I always remember my dad yelling from the sideline was, my ball. Loose ball, my ball.
Yep.
And I think it's the same way in business, or the same way in your career. It's like you don't want to step on someone to go get it. I'm not saying I didn't elbow someone to go get that ball, but like if you see that jump ball in the air, you see that loose ball and you want it, you got to go get it.
Yeah, man.
And it's just one of those things. My ball. It's always stuck with me in my head throughout my career.
That's perfect. Those are 3 good ones.
Yeah.
And the first one in particular is something that I don't think people practice enough. Yeah. And whatever gets in the way, pride, whatever it may be. Just being able to take responsibility for when you screw something up, or when things don't go a certain way. It's to your point, it goes a long way.
100%. And being the one to say, how do we fix it?
Yeah.
And coming through on that is really important.
Yeah. And then it's my ball.
My ball.
Fix it. Yeah. That's funny. I appreciate it, Brian. Thank you so much, man.
Yeah, Michael, this has been awesome. I appreciate the time, and hopefully this was fun for you and informative for the folks out there that will listen in.
Yeah, of course. We'll would love to do it again in the future, and we'll tune into how these Megaforces are churning along as the time goes.
I look forward to it.
Yeah, awesome. Well, thank you, Brian, and thank you everybody for tuning in.
Yeah.
Please feel free to like and subscribe. We greatly appreciate that. Thank you for listening, and we'll see you in the next one.
Thanks so much.
Bye.
Sharpe Minds is produced and hosted by Michael LaFata and directed and edited by Alex Weimer. Our music is made by Tony Sapiato and licensed through Soundstripe. Michael LaFata, Financial Advisor, Archstone Financial, 508-453-9800, 324 Grove Street, Worcester, Massachusetts, 01605. Securities and advisory services are offered through Cetera Advisor Networks LLC, member FINRA, SIPC, a broker, dealer, and registered investment advisor. Cetera is under separate ownership from any other named entity. Archstone Financial is not a subsidiary nor controlled by Cetera Wealth Partners. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks LLC and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results. The guest speaker interviewed in this podcast is not affiliated with or registered with Cetera Advisor Networks LLC. Any information provided by them is in no way related to Cetera Advisor Networks LLC or its registered representatives. Exchange-traded funds, ETFs, and mutual funds are sold only by prospectus. Investing in ETFs and mutual funds is subject to risk and potential loss of principal. ETFs incur trading and commission costs similar to stock, and frequent trading can negate lower cost structure of an ETF. There is no assurance or certainty that any investment or strategy will be successful in meeting its objectives. Investors should consider the investment objectives, risks and charges, and expenses of the fund carefully before investing. The prospectus contains this and other important information about the fund. Contact your registered representative of the issuing company to obtain a prospectus, which should be read carefully before investing or sending money. Cryptocurrencies, digital assets, and other blockchain-related technologies such as Bitcoin, Ethereum, NFTs, and others are not securities, not regulated, and not approved products offered by Cetera Advisor Networks LLC, and cryptocurrencies or other blockchain-related non-security products cannot be recommended, offered, or held by the firm. The mention of any products is for educational purposes only. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful.